world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. Today I'm thrilled to be joined by Joel Perlman. Joel is a UK-based serial entrepreneur. After starting his career at McKinsey, Joel eventually left to co-found Copal Partners, a financial resource outsourcing company, with his business partner, Rishi Khosla. Over a period of 12 years, they grew the business to almost 3,000 people before selling it to Moody's in 2014. Subsequently, Joel and Rishi founded OakNorth, a new UK bank focused on lending to entrepreneurs and mid-sized growth companies. From an outsider's perspective, OakNorth seems to approach banking in a pragmatic, entrepreneurial way, seeking cost-effective, non-traditional ways to deliver value for customers and outcompete incumbent banks. Formally launched in 2015, OakNorth is to date the only completely new UK bank to break even, doing so in an amazing 11 months. Joel, I provided a quick overview of your background. Tell us a bit more about OakNorth and what you guys do, both on the retail side and the lending side.
Okay, so OakNorth was created because we feel that the mid-size growth businesses in this country are very much underserved or abandoned by their banks. And we thought that there was a big opportunity to make the market more efficient by creating a platform for these companies. So on the lending side, it's very much a very simple product. It's a simple cash loan with a revolving facility. And we've kept it very simple because what we're focused on is actually the credit as opposed to the products. On the depositor side, it's, again, a very simple product suite. We offer fixed rate bonds and we're launching easy access. And again, that's what we've done till now.
So it sounds like a very focused product set. So presumably you guys do a small number of things and you do them extremely well, both for retail and businesses.
Exactly. That's exactly right.
To most people, starting a bank sounds like a crazy thing to do. So why did you do it? What was the motivation?
We started a bank because in 2006, when we were building our previous company, Copal, we were looking for a lending facility, a debt facility, and we sort of went to the various banks here in this country, and we had an offer for roughly, I think it was £75,000 from one of the big banks, and it required to put our property, our residence, as collateral. That was the offer we got in the UK. And then a month later, we went to New York, and we sat down with one of the big banks in the States, their special situations group, and they offered us $10 million unsecured. So when we saw that, we felt that there must be some sort of imbalance in terms of how the market works here versus the US, and therefore there must be a very big opportunity. And that's how we started thinking about a bank.
How is OakNorth different from other banks, both new and incumbent?
OakNorth is different from other banks. Let me just break that down. In terms of the incumbent banks, we have a much tighter and much more efficient credit process. That would be the biggest differentiator. Our credit process is built to take days or weeks as opposed to months or years, sometimes with the big banks. And the borrowers come directly to credit committee. They pitch their deal very much like in a venture capital, private equity type scenario. And our credit process is very bespoke. We will take situations and create an opportunity out of them as opposed to trying to straitjacket a transaction into a list of things that we can offer and that we can't. So we're super flexible. So those are the big differentiators with the big banks. And then with the new banks, most of the new banks are focused on the retail side. So we're very much a business bank still, and our projection is to be a business bank for a long time. We'll do retail eventually, but our core is business, and that's the big difference with the small banks, the new banks.
We hear so much about customers in the UK not being open to new banks or not being willing to switch to challengers.
What has been your experience, I guess, both with retail customers in terms of attracting retail savings deposits and also with businesses seeking credit?
So it's been a great ride with them, with both. We've had a very good experience. In terms of retail customers, what we found is that the retail customer in the UK is very price sensitive. So we offer these deposit bonds that are 1 year or 18 months or 24 months in terms of tenure. And if we offer just a few basis points higher than, for example, the high street banks on Money Supermarket, for example, or one of the other aggregators, we receive a huge amount of liquidity. So I think the concept about customers not switching banks, I think it holds for what we call current accounts. So for current accounts, when you have your direct debits and everything set up, and so for that, definitely there's a pain to switch. But if you want to take an investment position in a bond, then it's very seamless. So we found that in that scenario, it's very easy to raise liquidity. On the lending side, in terms of borrowers, again, I think borrowers, they have a current account which they want to hold, a small business current account, and that's hard to move. And we don't want that business anyway. It's a different business model. But when it comes to a loan, a straight loan, they have much less barriers to go to another bank and shop around. Since we don't offer current accounts, all of our customers are clients of other banks. But we have a very big pipeline of customers looking for loans because they don't want to deal with the bureaucracy and the delays in the big banks.
In part based on your background, you positioned OakNorth as a bank for entrepreneurs. In part based on your background, in part based on the fact that as you've seen, there isn't a great kind of capital markets support structure for startups, for entrepreneurs in the UK. Do you find that OakNorth is more open than, say, a traditional bank, an incumbent bank, to supporting a new business? And is that difficult to manage from a credit standpoint?
Well, we focus on not purely startups. We do businesses that have turnover from 5 million to 50 million pounds and are profitable. So those businesses are still run by entrepreneurs because in their early stage, but they're definitely not startups. So we are also very careful with credit. We look for the best businesses. They're a certain size, but we look for great management teams, profitability, growth. So from a credit perspective, these businesses are very much sometimes even less risky than bigger businesses because they're run by the founders. The founders have a lot of skin in the game, and they're profitable. So we get the best of both worlds.
And is it secured versus unsecured lending? Or
We do both. So sometimes we'll take property collateral, sometimes we won't, and we'll base it fully on cash flows. It's totally dependent on the transaction and on the appetite and on what we see. So we keep it extremely flexible.
Banks are notoriously capital intensive. Without compromising sensitive information, but what do the economics look like for a new bank like OakNorth? I mean, more generically, are you able to deliver a meaningfully more attractive return to investors?
Yes, the answer is yes. Banks are very capital intensive, but they have a huge leverage ratio. So if we want to raise deposits, we have to have capital of 15%. So there's a huge leverage point there. And also what we found is that the big banks are very inflated in terms of costs. So the cost management is not great at all. So if you run your costs efficiently and you price well, there is a very big return for investors.
I suppose that cost structure is a particularly relevant concept for you as a new bank. I think we've seen incumbents running cost-to-income ratios of well above 50%. They're kind of continuously in cost-cutting mode, which not only kind of erodes their infrastructure, but it kind of prevents them from innovating as well. You guys presumably run a much more infrastructure-light model and are able to achieve attractive cost-income ratios while still driving strong high-level revenues.
Yes, so we've broken even. We're profitable
already. Which is
already,
amazing. Yeah. Congratulations. Less than a year. It's phenomenal.
And that's because we are very cutting edge in terms of our technology stack. So our technology sits on Amazon, and we have an office in India as well, from which we do a lot of the back office work cost efficiently. We automate a lot of what we do. So we're not people intensive. Our milestones are based on loan book size to total headcount. And those are the two things that we track. And therefore, it's not just about building a huge asset book, but with how many people do you build it? So there's always a focus on cost. And we think we can deliver 25% or 20% cost income ratio quite easily with the current model. Obviously, it's early days, but once we mature, that's where we'll end up.
You mentioned the kind of the cloud infrastructure, the fact that you guys are operating on AWS, which was very interesting news when it came out. I think you guys were probably the first UK bank to do so. Was that a challenge to get through the likes of the FCA in terms of data protection and security?
It was. There was a number of conversations. They wanted to. The FCA, we found, is a very progressive type of institution. So they want to do things. They want to experiment. They're definitely wanting to keep up with the business world in terms of the technology, etc. So we had a lot of conversations with them to the point that they actually asked us to help them draft their policies around cloud. We gave a lot of inputs around it, and there was some back and forth with AWS as well. So I think both the vendors and the regulators were open to adjusting certain things, and we got there eventually, but it was definitely a process.
It sounds like you guys did great work in your interactions with the FCA, because I think they've subsequently moved to cloud systems, which is, as you mentioned, innovative. What's your ideal borrower? If you're looking across kind of the UK business landscape, what's the ideal company? What's the ideal kind of financing deal?
Ideal borrower is a company that is growing quickly. It's in the revenue parameters that I mentioned, 5 to 50 million turnover, where the founders still own a significant part of the business and are still managing the business. So those two things are quite important for us. And that's sort of the basic ingredients we look for. And in terms of ideal deal structure, we like to, we work in terms of how many turns of EBITDA, 3-4 turns. Loan to value, we operate around the 40% or so. That's sort of what we like to do.
And it sounds like one of the, I suppose you mentioned in terms of value that you can add to borrowers above and beyond simply providing capital. It's kind of the speed and efficiency with which you're able to respond to credit requests. I've heard great stories about you inviting businesses to your credit committee meetings, which you mentioned before, for increased openness and transparency when it comes to borrowing. Not only do I think that's a fantastic idea, I think it's representative of modern times, where we place greater emphasis on transparency. Interestingly, I guess we do so whether or not it's exactly what the customer wants to hear or not, because presumably there's situations when a customer comes in for a credit committee meeting and the answer may not be what they would like to hear. But presumably, I guess if you're working with the right sorts of companies, they appreciate kind of the reasoned decision and they take it for what it is. What has the response been from business owners and entrepreneurs and your credit team to that structure?
Yeah, no, it's been great, because I'll tell you, getting to a yes is great, but an early no is also great. So we found that a lot of these companies, they present, and they get a very early, not immediate, but within days, we say no and the reasons for it. They value the fact that we said no quickly, and they value the fact that we gave them the reasons for it. And they take that and then they improve their pitch, and then they'll go to another bank or maybe come back to us. But the most important thing is an early signal. And that's a big differentiator, because some of the big banks will take 10 weeks to say no. And that's when things drag, and that's when people get frustrated. It's a delay in the yes or no.
And so even your credit officers are comfortable having sorts of conversations and asking difficult questions in person to business owners?
Yes, absolutely.
If you're at liberty to discuss, are there any examples of deals that you guys have done?
Yeah, we can. It's public information. It's in the press. We did a deal for £19 million with Leon Restaurants. They were banking with another big bank, and they had an offer on the table from the big bank in terms of lending facility. But they preferred our approach in terms of not just the terms that we gave them, but also the fact that we understood where they were coming from. We sort of talked about how they were going to evolve their business, and we gave input into that. And they sort of, I guess, connected with us in a deeper way than with just their other bank. So that's an example. And what they want to do is with our facilities, they want to create 1,000 jobs and open 50 new restaurants. So that's one of our recent deals.
Are your customers London based? Because there seems to be a physical element. They need to come in person to pitch.
Mostly London and Southeast. because you're right, our credit committee sits here, and there is some of that. Having said that, we've had people from Birmingham, from the Midlands, from the North as well. But yeah, particularly at the moment, it's London Southeast.
What are your, I guess on that note, what are your longer term aspirations? Is it kind of a question of supporting the London and Southeast business community to the extent possible? Do you hope to expand geographically over time? Do you expect to expand your reach beyond the UK at any point?
Yeah, so we definitely would like to start covering the UK in a deeper way. In terms of geographically, we've been looking into growing into Europe eventually. So we think there's a lot of dysfunctional markets in Europe. Again, highly concentrated top banks owning the vast majority of the market share. And that creates a huge opportunity for us. But we need to think very carefully about credit because it's all about the credit. So we'll take these steps once we know what our credit model is going to be in terms of how do we expand our credit capabilities without deteriorating quality.
And in terms of product set, is there any thought at any point at doing anything, current accounts or FX, payments, cards, things like that?
We're looking at things. We're looking at everything. We are still sort of devising our strategy for our additional products because we're very busy with our current product, which is very simple, but there's a huge amount of demand for it.
Presumably when you get to start talking about things like cost-income ratio and the kind of very efficient way that you guys have structured your platform, being very good at a specific number of things for which there's great demand could potentially be a great long-term business model even without necessarily expanding too far. You and your co-founder, Rishi, are serial entrepreneurs. How does OakNorth fit into the progression for you and he as founders? Does it naturally follow from previous work you've done, apart from the recognized market opportunity?
I'd say OakNorth is, in terms of progression, I think it's our last one because we've given ourselves 20 years for this. It's going to take a while to build this to the size that we want to build it. So I would say, I'll be 62 in 20 years. And at that point, maybe I won't do the next venture. In terms of the logical progression, we were doing financial research before, and a lot of it was credit research. So we understood the model. We always wanted to be in financial services, and we've always been B2B in terms of our focus. So it fits well into our plans.
So it sounds like you're actually able to leverage some of that credit expertise in launching OakNorth. Apart from the technical skills like credit analysis, are there any other specific lessons you learned from your previous venture that have informed the way you've approached OakNorth?
In our previous venture, we built it with $60,000. That was the total use of capital, and it was sold for $600 million. So being cost efficient, bootstrapping wherever possible, being a little bit scrappy in our approach is something that we've learned. So that would be one of the lessons that we bring to OakNorth. Separately, we built a big company with an Indian focus. I found over the years that the workforce in India is excellent if you know how to leverage it well. So that component also fits into our OakNorth strategy. We will build our India operation to a significant degree. I would think the whole back office and middle office.
What's your view on UK business conditions at this point in the credit cycle and following Brexit?
I think from a macro perspective, there's going to be, a reduction in terms of GDP and things like that. There is going to be a recession or the like, but we're so small. And what we're seeing that there's going to be more of is the big banks taking a blanket approach and retrenching very hard from the sector, from lending. And I think that's going to open up incredible opportunities for new credits and very good credits that will be abandoned by the big banks. So we think from our perspective, from OakNorth's perspective, Brexit is a big opportunity. The cycle is what it is, but if you lend well before a downturn and you can survive a downturn and stay with your clients, then when you come out, there's a huge amount of goodwill and loyalty built, and then that can be those clients can be your clients for a long time. We've doubled our loan book since the Brexit decision was made, so we're growing actually faster after Brexit than before.
To grow a loan book at a bank, you need access to continued capital. And one of the reasons that we saw a fall off post 2008 in terms of lending from some of the larger banks, and one of the reasons we might see a similar fall off in the event where we were to move into a new recession is capital constraints. So either lack of access to capital or specifically, I guess, post 2008 write-offs, which eroded banks' capital bases and required them to effectively retrench in terms of lending. It seems like you guys have great relationships with your current investors.
Have you positioned yourself to ensure continued access to capital in the event that market conditions tighten up?
There's huge amounts of capital sort of sloshing around, especially in the US, for example. So everyone likes our business model. And now that the UK has become less expensive from a Forex perspective, I think there's going to be plenty of capital looking for this type of opportunity. So we're not concerned about capital per se. And our business is not we're not a 20 billion pound book. So the absolute quantum is not massive either.
I suppose it's worth expressing my personal view that having taken a good look at the challenger banking landscape, challenger banking may be the wrong term, the landscape of new banks coming to market, rebranding, lending companies applying for banking licenses to fund themselves with deposits. I think OakNorth has stood out. How does the low interest rate environment that we're in right now impact your business? And I guess more broadly, do you see low interest rates as being better or worse for either new banks or incumbents?
In terms of interest rates, our margin is what it is. So we have a certain margin, we have a certain pricing. If interest rates went up, our pricing would go up commensurately to maintain the margin. Having said that, we feel that we face pressure on the pricing side, on the lending side, because the absolute number would go up, and people don't look at the cost of capital, and they just say, okay, that pricing feels too high from an absolute perspective. So I think I would prefer for our interest rates to stay low, so we can continue pricing in a way that is palatable to the borrower. Also, higher interest rates, what they do is they slow down the economy. So I'm happy with our low-cost environment, and if that changes, we'll adjust, but hopefully it'll stay like this.
How did you find the banking license application process? Was it more or less challenging than you expected?
It was challenging. It was definitely challenging. My reaction was that the regulator, I wasn't expecting such a knowledgeable regulator. They actually are very on it when it comes to understanding the levers of what makes a bank work. And they were always asking on-point questions. So it was challenging, but it wasn't frustrating. We weren't sort of being asked to wait around and answer all these questions that were not relevant. They were asking the right type of questions. So I would say that it was a very good process, and I have a huge amount of respect for the regulator after that process.
We touched on it to an extent previously, but kind of the way you guys have thought about the technological infrastructure behind OakNorth. How important is technology to OakNorth?
It's immensely important because technology, doing it right, you've seen how the big banks have created monsters of their IT platforms, and that has made them very inflexible and very slow, hard to innovate, hard to launch products, hard to migrate things. Getting the technology stack right is essential for the business because it'll determine whether we can launch products quickly, whether we can pivot the business quickly. So the technology is essential, and also the fact that we need to automate as much as we can. Because if we don't automate, we need to hire more people, and it'll erode our cost-income ratio, and it'll create operational risk. So in banking, I would say technology is one of the very core elements.
I guess the flip side of that question would be how important is the human aspect to OakNorth? Because you invite customers then to pitch in person, as much as banks may hope that credits never go bad. In the event of an issue, there may be some manual intervention that might be beneficial in terms of rescheduling amortizations and interest payments and the like. Is there human support for your borrowers as well?
The human piece is also essential because the technology piece is the underlying part of the business, but as you said, credit happens manually here. We don't do automated models. We don't do on the credit piece is very manual by design because we think that people are better at assessing credit than machines, and we think that that's going to be the case. At least for our type of credit, it'll be always the case. We don't do the small ticket stuff that some of the other people do. So the people piece is extremely essential on the credit, on the monitoring, and on the recovery side of the business.
Looping back to technology. So much is said about the legacy systems issues that so many of the incumbent banks are working through. Of course, no one sets out to build a business that will eventually run legacy systems, but it can happen even with the best of intentions. What have you guys done to kind of avoid falling into the legacy trap over time?
Well, one of the big things is Amazon Web Services. By working with them in a way, we're future-proofing our technology because they're always upgrading their systems in terms of hardware, software, support. So that is a big piece of future-proofing it. And then I would say the other piece is keeping it simple. The more systems you connect, the more risk there is. So if you limit the number of systems, then there's less risk of creating a legacy thing. So we're very, very selective on which things we plug into our core systems.
Are third-party partnerships important for you at all, be it with fintechs or incumbent financial institutions?
We haven't started doing them as much. We are open to them, so we're looking at things, but for the moment, it's been very much our plain vanilla product distributed by ourselves. That may change over time, but over the years, I found out that these third-party partnerships, many of them fail because both sides are not as committed to the business, etc. So I am of a view generally that building the business and keeping it self-contained, at least at the early stages for a while, is really important.
I know you guys are active as a bank on LinkedIn, Twitter, Facebook, at OakNorth. Joel, what's the best way for people to get in touch with you or find out more about OakNorth generally?
Well, the best way is if they're interested in borrowing money, they can send an email to lending@oaknorth.com. If they are interested in depositing, they just have to go to our website, and there's a deposit link there with our various products. And there's a ton of press articles on our website as well.
Great. Well, Joel, thank you very much for joining us today.
Thank you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.